Market is searching for some direction off that hot inflation report, which showed inflation surging 7% over the past 12 months, according to the CPI. So what's your next move in the portfolio? Let's welcome in Lizanne Sonders, Chief Investment Strategist at Charles Schwab. Lizanne, always nice to see you. I think we could agree that inflation in some form is with us. It's going to be with us for the balance of this year. It may decelerate, but it's still with us. What is the best investing playbook for someone who wants to invest alongside these high levels of inflation, but alongside really what looks to be some rate hikes from the Fed?
So I don't think there is a perfect playbook. We can look at history. You can go all the way back to 1900, and if you use a proxy for small caps that predates an index like Russell 2000, which only goes back to the late 70s, and you look over decade-long periods of time, small cap domestic stocks are actually the only asset class, or maybe call it sub-asset class, that has outperformed every decade, outperformed inflation every decade. But we're talking about 10-year chunks of time. At the sector level, and we don't have sector data back all that far, but at the sector level, maybe no surprise, energy has been the most consistent outperformer in inflation. But it's also not just the inflation story, but the economic backdrop story. If you look just simply at an index like the S&P 500 and look at periods when inflation was rising or inflation was falling, maybe no surprise that stocks do better when inflation is falling than the opposite situation. However, if inflation is rising, but GDP growth is also in its, call it, highest quartile or so, the stock market has done quite a bit better than if you have the dreaded combination of very weak growth and rising inflation like you had in the 1970s. So I think you have to look at the combination of the economic backdrop and the inflation story to gauge how to invest in an environment like that.
Well, and of course, Lizanne, you got rising rates to throw into that whole mix as well, right? Although we know from history as well that especially in the beginning of a tightening cycle, stocks can still perform well. So when all is said and done, what's the best way to approach all of this?
Well, ultimately, I think it's the speed at which the Fed will have to move that probably defines market behavior, not just in a broad sense, but in terms of leadership. If you go all the way back to the post-World War II era and look at every hiking cycle, when the Fed was moving quickly, typically defined as a cycle where they're raising rates at, if not every consecutive FOMC meeting, most FOMC meetings versus, say, slow cycles where they might take a break for a meeting, maybe even two meetings. There's a huge difference in terms of how the market has behaved in a slow cycle. Now, given that the market in terms of Fed funds future suggests that we're going to get as many as 4 hikes this year, starting possibly as early as March, that starts to look a little bit more like a fast cycle. And I think that helps to explain why some of the growthier segments of the market, some of the higher valuations, some of the spec areas have taken it on the chin, because that's what tends to get hurt when you're in this more rapidly rising environment. But we really only have one other period that we can use as a comp when you add in the balance sheet component of this too. So this is not simply about rate hikes, but what the Fed does with the balance sheet. And the fact that QT has been brought into the mix, I think helps explain some of the weakness. So I think these bouts of volatility, some of these leadership shifts that can happen really quickly, I think that's likely to stay with us at least in the first half of this year, which suggests maybe an upped pace of rebalancing, maybe one of the disciplines that makes sense in this environment, to stay in gear by more frequently trimming where you're given profits and adding into where there's some recent weakness.
Well, speaking of recent weakness, Lizanne, tech stocks have been battered, especially the software names. Is it time to go in there? Has that space priced in these 4 rate hikes?
I think even within tech, you have to be value oriented. We've talked about this when I've been on your show. I take a very different approach to the whole concept of value and growth, using lowercase v and g in talking about the factors of value and growth, the characteristics of value and growth. So I think if you're a tech investor and you want to get exposure to the tech sector, that growthier sector, you can still screen for value characteristics, everything from strong free cash flow yield, reasonable, price to book, price to sales, strong balance sheets. You don't have to limit yourself to only the areas that are housed in value indexes to look for value. So I think especially in areas where you do have lofty valuations, try to look for where there's value, and then you get that nice hybrid blend end of reasonable valuation, but you still get some of those growth kickers. So that's the approach I'd take, not just within tech, but within all sectors. I would take sort of a sector neutral approach while screening for lowercase v value, the factor or characteristics of value.
Liz Ann, I want to talk shorter term for just a minute here, because I know that you've been looking at some breadth measures in the major averages, and in particular in technology. And you point out to us that a lower percentage of stocks in the NASDAQ, for example, are trading above their 200-day moving average than in the other averages. And there's some other kind of beneath the surface indicators you're looking at. What does that tell us about how short term we are going to see the major averages trade?
Well, in the case of the NASDAQ, it's somewhere around 37% of the NASDAQ is trading at least 50% below its 52-week moving high. And that's a pretty outsized number, given that the index itself is well less than 10% off an all-time high. And other than that happening once in December of just this past year, you have to go back to 1998, 1999 period to see the last time that happened. The only caveat, and maybe a bit of an offset, is that most of that significant weakness is in the micro cap end of the spectrum within the NASDAQ, not the bigger, larger leadership names. And I think that's tied to what I already mentioned, which is just how big a hit some of these spec areas of the market have gotten, whether it's heavily shorted stocks or non-profitable tech or weak balance sheet companies. The areas that were all the rage, SPACs, in the early part of 2021 have really taken it on the chin. And I think that weakness has also manifested itself in some of these weaker breadth statistics within the NASDAQ. But I guess, again, the good news is that the concentration is well down into the micro cap end of the spectrum, where, quite frankly, most investors, certainly institutional investors, that's not what they're kind of playing in. So I would suggest it's not quite as glaring a negative as when we think back and look at the 1998-1999 period and what we know that preceded. So I think that's an important caveat. But there's no question the weakness in breadth is more pronounced in the NASDAQ, in the Russell 2000, than in an index like the S&P.
Well, in this environment, we will certainly take a dose of good news. Liz Ann Sonders, always nice to see you, Chief Investment Strategist at Charles Schwab. We'll talk to you soon.